Hi guys, this is Terry with Futures.io, and it's my absolute pleasure to welcome back John Grady of No BS Day Trading for today's webinar, Sharks versus Sharks, Facts and Myths about Banks, Funds, Market Makers, and Prop Firms. If you have questions during the webinar, please feel free to type your questions into the questions box. We'll do our best to answer them at the end of the event. Also, if you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to comment and subscribe to our channel. It really helps us a lot. Please follow us on Facebook, YouTube, and Twitter with @Futures.io for news, events, and trading related information. And now, without further delay, I'll hand it over to John.
Okay, thank you, Terry. Sorry.
1 second, you'll get the pop-up.
No problem. Good to go?
All right, looks good.
All right, thank you, sir. Okay, thank you, Terry, very much for the introduction. Thank you to Mike, obviously, at Futures.io for asking me back. I always appreciate the invite. Hopefully it means I'm doing something right in each presentation. And thank you to everybody who attended today. As usual, I'm going to try to maintain focus and streamline some information. It's very simple today. I have a document that I'm going to read from a little bit. The reason I make these documents is because it keeps me on target and keeps me from digressing and getting off topic. And then as usual, I'm going to show some recordings of price action and a few trades to try to demonstrate, how this is applicable in real time, right? Because that's what it's all about. So anytime I share information, I'm always trying to share information that I think can be applied, and I try to show how that's done. Okay, so bear with me just a few minutes while I read through some of this document, and I'm going to go back and forth between the document and you'll see some recordings here of my workspace. Okay, so to start, the title of today is Sharks versus Sharks. What does that mean exactly? So when I refer to sharks within the trading realm, I'm referring to either institutions such as investment banks or big funds, or very large individual traders who move size. Okay, so by size we mean an above average amount of volume and contracts, right? So for example, your average trader sitting at home, it's probably, let me give you a quick rundown from left to right. I watch the Treasury notes and bonds and the E-mini S&P. So we have the 10-year, we have the Treasury bonds, we have the 5-year notes, and we have the Ultra bond, and then we have the E-mini S&P on the far right. So you are aware of what that is from this point forward. Your typical trader trading from home is normally swinging, 1 lots, 2 lots, maybe 10, 20, 30. It depends on bankroll and whatnot, but usually he's not swinging thousands of contracts, or even hundreds for that matter. So when I talk about sharks, I'm talking about the guys who can actually, for example, throw out an offer of 4,500 contracts in the 10-year, or somebody who can throw out an offer of 1,000 contracts in the E-mini S&P. Now that may not be all of one person, but quite frequently 1 or 2 people, or I should say firms, guys on trade desks, will comprise a large part of that bid or offer. So you might see an offer here, for example, of 1,066. 400 of that might be one person or one trade desk, and then 300 might be a second trade desk, and then the last 366 might be smaller orders from 1 lots, 2 lots, 5 lots from prop trading firms or firms running HFT programs with smaller size. Okay, so that's what I mean when I say sharks. All right, the reason this is important to kind of understand, most of the volume in the markets is executed by a handful of major players, and there have been plenty of studies, independent studies as well as government studies for that matter, which prove that to be the case. While there are certainly many retail traders in the world who execute trades from their homes or their cell phones, the retail trader volume is an extremely small fraction of total volume. So the idea that a major bank or principal trading firm would commit to buying or selling thousands of contracts in an effort to scare out retail traders is a myth. The bigger players are battling each other. So what do I mean by that? Sometimes I get questions and somebody asks, or many times really, about, well, are they throwing up a big bid or a big offer to scare out the retail money? And the answer to that is yes, but that's not really the main focus here. And I think a lot of people, particularly people who have never seen the industry from the inside, so let me just say on that note, I have worked for more than one proprietary trading firm. I have met investment bankers and guys that work at big funds, guys on the floor, etc. It's actually not a very large community, believe it or not, the trading world. So I'm speaking from firsthand experience here when I say this. Sometimes retail traders get the idea that a bigger shark, or a bigger player is throwing up a bid of 2,000 to scare out the retail traders. But realistically, if he's throwing up a bid of 2,000, he's not trying to scare out 2,001 lot traders, right? That's not the goal here. What's happening is he's trying to press the market in such a way that some of the other traders who trade 200, 300, 500 contracts, he gets them to go out or gets them to get behind him and go with him, right? So it's predominantly a bunch of bigger players fighting each other all day long. And so I also get the question, well, then who's making all the money? Because I hear about these guys making all the money, and we'll get to that in a few minutes. They come and go. The bigger firms tend to stay around because they have their hands in multiple fields, so they might actually have a desk that trades equity index futures, and the desk might lose money year end, but they have other desks that trade grain that make money, and maybe trade energies and they make money, and then maybe they're involved in some real estate transactions as well. So your big banks and firms have their hands in many different scenarios and many different products. So yes, they do lose, they do win, they go back and forth, they go out of business, new ones form. That's just the nature of the business, okay? So basically, sharks attack sharks, and then what I say is the retail traders on the minnows, which are trying to benefit from the movement created by the sharks, okay? So I'm going to just give a kind of a brief overview of a few different institutions. Obviously, I'm not going to cover everything they do. I don't even know everything they do in depth, but I am familiar with a lot of the trading desks and how they work. So I'm going to do that and then go into showing, like I said, some samples and price action. So you have your investment banks, right? Extremely well capitalized. They usually have trading desks for every type of market, equities, commodities, fixed income, currency, and whatever else you can imagine. So that goes back to what I just said, which is these guys have desks that cover every product in the world. They're constantly working programs, they're using discretionary methods, they're trading short term, they're trading long term. They're also involved in real estate, bonds, taking companies public, etc. Right? So they're in all kinds of products. They're involved in the futures markets as well as the cash markets, so they frequently execute spreading and hedging techniques. By that, what I mean is they might be running a program in the E-mini S&P while simultaneously buying or selling a basket of stocks that reside within the S&P 500 index, okay, while also simultaneously working some options orders as well, okay? So they do a variety of strategies they implement. If a bank needs to move size quickly, price will almost always change due to the amount of contracts which trade. So what I mean by that simply is when these guys move size, a few thousand contracts, they influence price. That's all there is to it. It's not a debate on this. It's just if you're looking at the market, and we've all been caught on the wrong side of this, and I'm going to show you what happens when you get caught on the wrong side, the first trade sample that I have. But you're sitting there and you're looking at maybe a large order, and you see 1,000 on the offer, or you see 2,000 on the offer, and all of a sudden the entire order just gets taken out. It gets taken out because one or two sharks hit it hard right away with maybe 1,000 contracts, 1,500 contracts. And they may have those broken down into individual orders, like 5 lots, 10 lots, 50 lots, but it's all set to go at the same time. And so when a bank moves size, it typically moves price, okay? You then have your major funds. So talking here about investment funds, mutual funds, hedge funds, okay? While some funds do have desks which execute short-term strategies and they run programs, the majority of fund investing tends to be in long-term plays or in fundamental plays based on things like trying to project the earnings of a company, crop yields, figuring out what the interest rate hikes are going to be or if they're going to be lowered, etc. If a fund has $1 billion under management and is looking for 20% returns, it cannot specialize in a few markets because the law of diminishing returns eventually comes into effect. So in other words, trying to take 200 million out of one futures market each year would be pretty difficult, to say the least. What I mean by that is if you have a fund that has $1 billion under management, they're often looking for very large investments. They need to allocate large quantities of money to investments that give them a decent return. So they raise money from qualified investors. They take a management fee plus a percentage of the profits, if any. One of the beauty of funds, of course, is if you lose money, you don't lose any of your own money. If you make money, you get to keep a percentage. And regardless, you're usually getting 1.5% to 2% management fee. That fee is used. They have desks and compliance and lawyers and everything else, but still, it's a very large chunk of change right off the top. And just to briefly explain this, I wanted to give an example of minimum allocation amounts. I had a friend who had a very small fund. He had raised a little bit of private money, and he'd raised about $500,000. And he was trying to run a particular strategy that he had that was a longer term strategy. And so he was looking for more capital. And he managed to become associated with a gentleman who ran a fund that had 700 million under management. So he contacts the guy and they sit down and he gives the guy his pitch. And the person who runs the fund looks at him and says, well, it sounds like a good deal. He said, what kind of money are you looking to receive and what kind of returns are we talking about? And my buddy said, well, I'm looking for about 2 million and probably in the neighborhood of 20 to 30% a year. And the guy who ran the fund said, that's nice and it sounds like a good deal, but I only do 10 million blocks minimum, right? So my buddy didn't actually ask for enough money is what happened there. And it wouldn't have mattered because with his strategy, he could have never moved $10 million in the markets he was trading. They were thinner markets and there's just no way that he could have achieved those kind of returns with a $10 million bankroll, okay? So it's not a great show, I don't think, in terms of being well written, but there's a show on Showtime called Billions. It's precisely about these types of funds. Some of the information is accurate, some of it's not so accurate, but it gives you a little bit of an insight into how funds work if you take away all the insider trading nonsense, because that rarely happens. But they do spend a lot of money trying to figure out what companies are going to do, if they're going to develop products, et cetera, okay? So those guys contribute a little bit of volume, but typically not as much as investment banks, and also not as much as your principal trading firms. So a principal trading firm is a firm which invests only the partner's capital. They're typically not nearly as big as banks and funds, but they execute a large amount of volume on a daily basis, and the primary focus tends to be on high-frequency trading techniques. A principal trading firm can also be a proprietary trading firm. I mean, technically it usually is proprietary, but your bigger principal trading firms tend to be a group of guys that pull their own money together, hence the term principal, and they're trading their own strategies. So maybe a small group of individuals put together a few $1 million and they have some high frequency trading programs that they've written, maybe some discretionary techniques they're using as well, and they're doing a lot of volume on a daily basis and just trying to make money for themselves. Whereas a prop trading firm hires other traders, okay? And we'll get to that in a second. you have market makers. Very few banks and firms have market maker status. Being a market maker allows them to essentially have the fastest access, pay the least in fees, and sometimes get pro rata fills. What does a pro rata fill mean? This is what a pro rata fill means. It means, let's say I'm the very first guy in the queue here. There's 1,462 on the bid, right? Let's say I was the very first person to place an order of 20 contracts there at even. Let's say a market maker that does a lot of volume every day, then layers an order over top of mine of 400, right? If 20 contracts trades at even, most likely I'm going to get only a partial fill. So even though I'm first in line, my 20 contracts are the first sitting there resting at the bid, because the market maker is a market maker and has market maker status, there are algorithms that are used to assess how much of each order he gets filled of his own. And so sometimes in a situation like that, the market maker might actually get 10 contracts and I may only get 10 contracts. Or the market maker might get 12 and I may get 8, let's say. Depends on how it's broken down. I know people can debate, exactly how much it is. The CME publishes the algorithms and regulations they use for that, so you can certainly read up on it more if you'd like, but just be aware that there is a reason market makers apply for market maker status. In a way, it gives them that advantage. They usually have direct access, not usually, they always have direct access. They have the fastest connections, they get the orders, sometimes in a pro rata form. And, the argument that's used is that in theory, they provide liquidity, because they're adding orders, and usually on both sides. So you have what are called pairs orders. So what a market maker might be doing is he might actually have a bid at, let's just go to the ES, he might have a bid at 25, a bid at even, and a bid at 75, an offer at 50, an offer at 75, and an offer at 20 even, okay? And the idea is that he's adding orders on both sides and therefore contributing liquidity to the market. The truth of the matter is he can cancel those orders faster than anybody else, or maybe not other market makers, but it's a competition in that realm. And so if the market's heading one way, a market maker is not obligated to sit there and eat a loss. They do have to do a certain amount of volume, but they can definitely adapt in terms of what's happening, and they can change their orders around extremely fast, and they do so frequently as well. They can also make quotes over the phone. So if somebody wants to call in a market maker because they want to move 5,000 contracts in the E-mini S&P all at one clip, they can call a market maker and see if they can get a quote. And that transaction will never show here. The market maker and the firm will do it over the phone. Okay, so just FYI, that takes place. And then you have proprietary trading firms. Prop firms may be well capitalized, or they may not. I speak from experience on that one. There may be 5 traders at the firm, or there may be 50 traders, but most prop traders do not trade much size. Now, there are some very big individual traders in the world who work for prop firms. But in general, what a prop firm does is some investors come together, they put up the money, they buy the computers, they rent the office space. Ideally, they lease seats, which will enable them to pass along very good exchange fees to their traders. And then they hire traders in an effort to find guys that will hopefully become great traders, and then they take a percentage of the profits, okay? That's the way prop firms work. It's kind of where I learned the business. Prop traders are not typically going to be responsible for initiating a directional move, but they may contribute to its continuation if the entire office is going the same way at the same time, and a few of the traders move decent size. So just quickly, let me explain. When I say the entire office is going the same way at the same time, I don't mean that it's a concerted effort necessarily, or that people are all saying, hey, let's all go long at the same time. But what can happen is if you're in a room of traders and the market's basically heading one direction, everybody sees that and they all start going the same way. So you might have some firms out there that they see that some sharks are making moves. They in turn start selling their 5s, 10s, 20s, 50 lots, and that helps to maybe exacerbate the move, right? Or continue the move as the smaller orders follow the bigger orders. Okay. So that's just a rundown of some of the institutions that move a lot of volume in the markets on a daily basis. I started making kind of a list of facts and myths, and then I realized that it was just turning into being redundant. So there's really only two that I want to focus on here, and then I'm going to get into high frequency trading and show you kind of how it works. One fact is that many institutions do make an incredible amount of money. That's obviously true. Okay, we all know that. But a myth is that all institutions make money, and that's where I was going in the very beginning when I was talking about sharks versus sharks. Some investment banks make a lot of money from their trade desks. Some make little money from their trade desk or lose money from their trade desks, but it's offset by other departments. Some principal trading firms take their shot and they miss and they go out of business. You know, sometimes guys get on the wrong side of the wrong sharks. A quick anecdote here. There was a company, I knew guys that worked there. They got themselves into an oil trade, an oil option trade, and they were averaging into a losing trade, and they got their position built up to 1,000 contracts, 1,000 options. And at that level, there's only a few other people in the world who would take the opposite side of that trade. There might be some retail traders, you know, trading 2, 3 options against them, but typically it's going to be market makers and guys on the trade desks for oil companies. And essentially what happened was, it was just the firm that was on the wrong side of this trade. They were sharks, there's no doubt about it. They were huge, but they came up against a bigger, badder group of sharks. And the market just kept moving against them until they were eventually forced to liquidate at a loss. And so this massive move took place in the oil options market. This was a very long time ago. And it was basically down to one principal trading firm up against market makers and guys at, you know, the oil companies pressing against them. So be aware, they do lose money, okay? Fact, when a large bank or firm moves size, it moves price. That's true. I mean, if somebody comes in and they need to move 3,000, 4,000 contracts immediately, they're going to move price. A myth is a lot of volume trading means a large player is getting ready to try and move price. So this is something that I try to explain to people. Just because you see a lot of volume doesn't necessarily mean that you have guys gearing up for a move, okay? And one of the main reasons for that is high frequency trading, okay? So high frequency trading and its effects, and we're going to get to some price action here in just a second. HFT programs are simply programs which execute a large number of trades on a daily basis. The orders may be for a 1 lot or a 50 lot, but the idea is the same for most of the trades. They want to be in and out of a trade very quickly and exposed to the least amount of risk as possible, ideally zero risk. This type of trading most definitely causes more chop than would otherwise happen. So how does one achieve near zero risk with an HFT program? Okay, so I'm going to show you a sample here. What I'm going to explain right here is it's based in reality, okay? So it obviously depends on whether or not a firm, how they program, you know, their programs. But I'm faltering, excuse me. This is the basic idea, and then we're going to move on to some trades. The basic idea goes like this, because a lot of people hear about HFT all the time, but they don't actually understand what HFT is, okay? The S&P is moving down, trading at lows for the day, right? It's somewhat weak. A program is in place, let's say with a principal trading firm, to sell a 10 lot if the market trades at 19 even. So you have 19 even here, you have 990 contracts on the bid, right? However, the HFT program is only programmed to execute and go short if that 990 falls below, let's say, 300. Okay? So what's happening is, and I'm going to fast forward just a little bit because I realize I used some time here. The market starts to trade down. Sorry, it bounced a bit here, and then it does start to move down. Oh, there it goes. All right. As the market begins to go down and orders hit, now you see how that 990 drops to 700? What will happen is an HFT program will be programmed to try to sell a 10 lot if that 718, let's say, drops below 300 or 400 or 200 or 150 or whatever the program is. But the idea is it's typically volume based. So whatever the volume is, when the volume gets below a certain amount, it trades. So let's say right there, when it trades, it drops below 400. An HFT program goes short 10 contracts at 19. As soon as it goes short, it immediately works a bid. You know, it could be 1 ticks, 2 ticks, 3 ticks, whatever. For hypothetical purposes right here, I just want to show you. Let's say it goes short at 19. It immediately works a bid at 1850, okay? Now, the market moves in its favor. It goes offer at 19, 398. It starts trading 1875. The HFT has a bid working at 1850. In addition to that, what often happens with a program is it's now programmed that if this order here of 398 falls back below 100 or 150 or 50 or whatever, that program will turn around and buy at 19 and blow out for a break-even trade. So what it's doing is it's going short as the market is going down and the bid is leaving, and it's looking to capture hopefully a very quick 1, 2, 3 tick profit. And if it doesn't break in its favor, it's going to buy and try to break even. In this situation, like let's say right there, it breaks down, and there it would have been filled at 1850 in a matter of a couple seconds, right? It's as close as you can get to a risk-free trade, essentially. Sure, they could have sold 19s, you know, and hit a wall and the market might bounce. But in a scenario like that, it takes a shot, it's instantly in the money, it instantly works a bid, it gets the fill. It is essentially risk nothing to make something. And that, in a nutshell, is what HFT programs do. They look to fire off trades like that all day long, typically on smaller size. HFTs aren't usually moving 500 at a clip, you know, because that's too hard to get in and out of. They're moving smaller size, 10, 5, 20, 25, whatever. And they're doing that, and they're taking shots all day. They're members of the exchanges usually, so they pay very little in exchange fees, so the round turn cost is not very much. All right. And so you got a guy or a firm, they hit a 10 lot, they make 250 bucks in seconds while almost taking no risk. That's HFT. Okay. So the best times for trading tend to be during what one might call a methodical feeding frenzy. Not the insanely fast movement that follows number releases, but during times where it's very clear that sharks are hunting each other as well as hunting everyone else. And they're hunting with some decent size. So you have bigger players, they're hitting hundreds, 200s, 300s. That's creating, you know, principal trading firms, prop traders, and large individual traders. It makes them jump on board as well. Maybe they bump up their size, and they exacerbate the moves, and they contribute to the domino effect. So in a situation like this, what do you have? You have some heavy hitters are willing to take a shot and sell at 75 and 50. That makes some principal trading firms and prop traders hit shorts at 19 and 1875. That in turn makes a couple of guys who are long at 50 puke out and bail, and you get a market that essentially drops and sweeps, as the S&P is prone to do. And I'll show you just real fast. and there it kind of goes down, right? And it's essentially everybody piling up going one way, but sharks have to initiate that move, and some sharks are going to get run over and some sharks are going to be on the right side, and then everybody's going to try to figure out which sharks have control, and the smaller traders are all trying to go that way. All right. So the reason I wanted to show that type of price action is because, and I realize it's obvious maybe to some people, and that's great. Obvious examples get the point across very well. You have price action like that, where the market snaps 8 ticks in a matter of less than 30 seconds because it's somewhat of a feeding frenzy, okay? If you contrast that, jumping to a different day here, where you have a market at highs, but what you don't have is you don't have that feeding frenzy. And just to show you, so I can skip forward and get to some other stuff, on my dial here, you'll see it's 2 minutes and 31 seconds. The market basically never showed signs here, as you'll see. There are some sharks, and there's some volume here and some volume here, but it's basically just a small group, maybe one or two, and then you have some HFT programs that go long, scratch, go short, scratch, go long, scratch, go short, scratch, right? And so you see some volume building, but it doesn't necessarily mean that anything's going to happen or that there's people gearing up for a big move. And if you compare days like this, or you compare this kind of action with what I just showed you, you can very clearly see a difference in the way the orders are ebbing and flowing. And this is where I lead into the concept of order flow, right? If you're watching order flow, you can sometimes get a feel for when the sharks are in a feeding frenzy and when they're not. And that can, I'll use me, sometimes I stay out of trouble that way. So in a situation like this, I can see that there's no feeding frenzy there. To me, the break to highs looks like it's not very likely given the fact there's no feeding frenzy. And so I sit on the sidelines. When the market's snapping like I just showed you, in my opinion, there's only two ways to be: either flat, because you think you've already missed a party and you don't want to sell at the bottom, or short. There's no point in stepping in front of a feeding frenzy like that, okay? Or a train, as I call it. And so in this scenario, just to kind of jump ahead, the market basically stayed at those prices and then kind of falls in, as you see, and it doesn't break highs. So you don't have a feeding frenzy, you don't have guys going for highs, you don't have sharks willing to aggressively attack the offers, and then eventually some guys give up and the market falls back in. But even though it falls back in, it takes 12 minutes for the market to move 8 ticks in this sample, whereas it took 30 seconds for it to move 8 ticks in the first sample, okay? So again, I'm talking about this for this purpose right here, which is technical analysis, some of the problems with it. The biggest problem, in my opinion, is that it doesn't offer much insight into what the most likely chain of events is right now. If I'm watching a chart, I can only see where price has been and where price is now. I can't really get a feel for the ebb and flow of the orders in the moment, right? If I'm looking at lines on the screen, I can't see bids, I can't see offers, I can't see transactions, I can't see how the market's behaving. If I'm watching the order book, I can see where price has been, where price is now, and how the orders are influencing movement, okay? I can sometimes get a feel for when the sharks appear to be pressing hard, like in the first example. That's when I want to be involved. Sometimes I can see they're not pressing hard, like in the second example, and that's when I typically don't want to be involved, okay? Most traders know about HFT programs, right? They know speed must matter, considering the infrastructure that's built around transmitting orders as fast as possible. They know market makers are usually always in the market working orders on both sides. They know there are traders who do nothing but scalp ticks all day long. So the legitimate question to be asked is, why is there still so much emphasis placed on studying traditional technical analysis strategies? And I'm not talking about previous days high and low. I watch the previous day high and low. Of course, I know there are points like that everyone's going to be watching. But when the market gets there, I'm watching the ebb and flow of the order book to try to see if there's any information that can help me identify what's likely to happen. So when I talk about traditional technical analysis, I'm talking about patterns, right? People talk about pennants and flags and head and shoulders and, whatever, and Fibonacci extensions and that kind of stuff, and moving average crossovers and all these various things. And I know that everybody has their way of thinking and their style, but reality sometimes, the reality is looking for patterns within the chaos can be quite counterproductive when the only real pattern in some moments of chaos may be the pattern of HFT programs constantly hitting in and out of 5 lots every 30 seconds. Okay, so that's what I mean. When you're in areas and the market's moving and it's really only moving because of a domino effect, orders feeding on orders, the idea that it matters whether or not the market's broken a trend line is usually a false idea, because if it's broken the trend line, the HFTs have already responded. They're already there. They took advantage of it when it was breaking the trend line, and they're already out. So as a retail trader, or maybe even as a prop trader, whatever, if you're someone at a firm, you want to keep this in mind when you're developing your own methodology. So people often try to see things which are not really there, and they tell themselves they have information which validates their beliefs even when they don't have that information. And order flow traders have to be cautious about this as well, because order flow traders can do the same thing. An order flow trader may very well have been caught on the wrong side of a move and be down money, or may have missed a move and be upset about it. And now he begins looking for something in the order flow to get him into a trade, rather than allowing what he's seeing to show him solid information. So what I mean by that is you can be so anxious to get into a trade because you want to be involved so badly that you tell yourself, well, they just moved down off the top. I guess they're going to stall out and go down. And then you go short at the exact point where the ES goes right back to the high. You didn't actually see something in the order flow that gave you a clue. You're just looking for something to trigger a trade. And those are other problems that I've discussed in other videos. So why does the average trader want to understand this, and how can this be applied in real time? That's always the key, right? So that's what everybody wants to know. Is there information in the order book which can actually help a trader make a more informed decision? Okay, so I'm going to show you 2 quick samples here of trades that I made, and how watching the order flow helped me with the trade. All right, so in this first sample, which should start right about here in just a second, there it is. Okay, I am short the 10-year Treasury notes at 2.5, and I have an emergency stop really as at 04. It's not typically in a situation like this, I would have normally probably gotten out with like a 2-tick loss instead of a 3-tick loss, or maybe even a 1-tick loss. It depends on the scenario. And arguably, this wasn't the greatest entry in the first place, but this makes for a very good example in terms of watching the flow and the order book kind of cluing you into things that you wouldn't see otherwise. What you're going to see is that the market's not really moving, and it hadn't really been moving much. It was very, very slow here. I'm suddenly going to be taken out of this trade as the market jumps to 4. Okay? And I'd already been in this trade for a couple minutes at this point, and the market had barely moved. So there's a reason that I'm showing this. So let me show you this. Do you see how there's 4,000 on the offer and 500 on the bid, and the market's barely moving? Just like that, in a matter of a second or two, the market jumps 2 ticks. I get taken out for a 3-tick loss. And I realize that to people who trade oil and gold, that might seem, normal, because it is in those markets, obviously. That's very unusual in the Treasury markets when it's that slow. It's very unusual for them to jump like that. So immediately my mind goes to long, probably need to reverse here. And I wait a second just to see, because that typically means something's happened. There's a news event, there's a data release, there's whatever. The interesting thing about this particular situation is the equities didn't respond at all. This was isolated to the treasuries for the most part. So I wait a minute. And there it goes again, right? It's jumping again. That's a sign that something's up. again, we're talking about maybe an obvious scenario to some people, but to people who are new to order flow or who are trying to understand some of the benefits of it, that's why I'm showing this. That's the immediate signal within the order book that I probably need to be long. So I turn around, I reverse, I go long at 5.5. I'm immediately 2 ticks in the money. I offer out for 3, which was actually a mistake, because if I'd waited a few seconds, I could have made another 3 really easy. But I take a quick 3 ticks of profit there, and then the market goes up a couple more ticks. So I'm of course annoyed that I didn't get another 2 or 3 ticks out of the trade. Sorry, back that up real fast. But it's a good example of living in the moment and responding. And the point of that is you have to understand there's nothing predestined or predetermined about that. And that's where sometimes guys that focus on technical analysis miss the boat. They don't realize that, I'm responding, with my very small amount of contracts to that movement, and other HFTs are responding with their small amount of contracts, and then heavy hitters at the investment banks and the bigger principal trading firms and maybe a fund are also responding to that, and it just becomes this domino that carries it one way. And so if you're living in the moment, you can sometimes identify that type of movement and take advantage of it very quickly. It's not that I always reverse, but it's just there are moments like that where you might know, there's only one way to be. It's long or flat, again, a flat, one or the other. There's no reason for me to step in front of movement like that, and it can easily be seen in the order book. So just one more thing I'm going to show you, because I know I'm already at the 40-minute mark here, and then we'll go to Q&A. I ended up taking a short trade, and here at 31, and I'm going to kind of breeze through this real fast. The entry isn't really why I wanted to show this example. Again, I want to show this example because I want people to see, they say, I don't know how you make heads or tails of what you're seeing in the numbers. They change so frequently. What are you looking at? I don't see how it's useful at all. So I take a short trade at 31 because I thought the market was going down. I mean, ultimately that's it, right? There was information there and I thought it was going down. But where I want to focus on with the sample is I want to focus on using order flow to help manage a trade, right? So it's not just about using your entry or choosing your entry. It's about managing the trade once you're in it. Where really am I wrong? Am I right? Should I stay in the trade? Should I take the trade off, etc.? Okay. Now, I had no intention of allowing this to go all the way to 1. That's an emergency stop order that I always place in case I lose my connection. But what I want to show you is the market does move in my favor a little bit here. All right. And you can see right here, you see how you have 3,960 contracts resting at the bid? I want you to watch what happens there, okay? And this is one of the techniques that I use, and I can see this in the order flow. And again, this is where order flow has an advantage over pretty much every other style of trading, in my opinion. There's 3,960 contracts on the bid. Watch what happens when they trade down to 30.5. It's going to take just a second, so I'm going to fast forward. Still see 3,900 there. Be about 4 seconds here. Now it's at 3,300. That means 600 contracts have canceled. They're your market makers pulling their orders. Now it's at 2,400. It's dropped from 39 to 24. So now 1,500 contracts have canceled at 30. Nothing's traded there. And now it's at 1,300, right? So 2,600 contracts drop away from that bid at 30, right? All those orders cancel. That's the power of being a shark who can layer orders on top of other orders and throw out these bids in an attempt to make the market look strong, and then pull the bid to make it look weak and help move the market down the other way. All right. So the point of that is, you know, when I see that, I basically hold the trade to give it some time to work in my favor, because that's usually a sign of weakness. And in fact, it took a minute for this to play out, but it did end up breaking. There it breaks again. You know, again, some bids pull away is what happens. And then it trades down a little bit farther. And then eventually what happened here, because I know I need to wrap it up for Q&A, it hit a spot where the bids were basically no longer pulling away like that. It hit more volume, and it was a pretty decent winner given the type of trade that it was. And so I ended up placing the buy order there and getting the fill at 28.5. Okay, so I make losing trades too. Obviously, you just saw one. I got ran over for 3 ticks in that first sample. The goal there is not that, you know, again, to show like, hey, I made a 5-tick winning trade. The goal is to show how it's possible to use information in the order book to help you manage a trade. And see, I think stuff like that is proof that there is information to be had in the order book that can help you make a better decision, right? So that's really what it's all about. Is there actually information there that helps you? Is there a way to discern movement, or at least, you know, for the next few ticks? And at moments you can see things like that. And it depends on a lot of things. You know, there's other factors involved, but things like that can help give you information in the moment to let you know, hey, I want to hold the trade, you know, or I don't want to hold the trade, I want to get out. All right, so just to kind of wrap it up, these are some other thoughts, which is that order flow traders tend to find more trades in a day than technical traders, just in general, not always, but in general. If you're watching the flow, you can sometimes play back and forth. You know, you can play ranges, and you might be able to scalp 6 or 7 ticks in a range, whereas a guy sitting in a trade, you know, waiting to get 7 ticks or 8 ticks, and all he can get is 3, and he just keeps watching it go back and forth in his face. He never takes a profit. On top of that, there are many other factors which go into developing a good methodology. All the usual suspects, such as psychology, cutting losses, waiting for your spot, avoiding revenge trading, etc. But having a grasp on the way sharks tend to trade is one of the major factors in the equation. So all athletes and business owners study the techniques used by their competition. Traders should do the same. That's my final thought. And just on this same topic, a little plug for Jigsaw Trading, some of the videos they do, which are on YouTube. Jigsaw has a video called 2020 Market Vision, staying on the right side of the market. And in it, Peter Davies does a very good job of also discussing high frequency trading and how it affects the market. So if you do have an interest in that and you want to follow up on it with some more information from a different source, that's a really good video to watch. All right, so with that, I will turn it back over to you, Terry, and we can do some Q&A.
All right, sounds good. Let me get the questions in order. Let's see. What are the advantages of working for a prop firm versus being a retail trader? And would you go back to a prop firm if you were invited?
So I get that question all the time. I personally would not, because it doesn't suit my life goals. You know, I'm a little bit older, and it's not something I would want to do. Typically, if you join a firm, you have to live in one of the bigger cities. I mean, Chicago or New York or London. There's some firms like in Sydney, Australia. You know, some good firms over there. If ideally in a prop firm, ideally, and this varies with the firm, you have obviously somebody else putting up the money, so that's a plus. You would want to have a firm that does lease a seat or was willing to lease a seat for its traders in order to reduce your exchange fees and your costs. You can do that on your own as well, but you know, some firms have that as part of their package. And also ideally you would have some mentors there that would help you out. And so I don't like to really go for or against because prop firms vary drastically. I worked for one that was a terrible firm that was undercapitalized and ran by a guy that didn't need to run it, and it wasn't a good deal. And but I got a job at a better firm in Chicago, and that's how I learned what I learned. So I would say if you're a younger person and you're willing to make the move, it's a good deal, and it'll put you in the environment, and you can probably learn a lot from it. But I guess the caveat would be prepared to put in a year and a half in a different city, and be kind of poor, because they don't pay a lot. So I'm just trying to be honest. But the flip side of that is if you get in with the right firm, you might learn a lot in how the industry works and make some great connections. So it's pros and cons.
Okay, sounds good.
Sure.
All right, it says I trade stocks and sometimes I see in the tape huge size like 100K shares in Apple without any immediate impact on the price. How is that possible?
Because everybody trade the heavy hitters trade Apple. That's why. That's really the short answer. It's one of those stocks like Microsoft and some others that major funds trade it, and so 100,000 shares may move the market a penny. That's that can be good and bad. The same concepts do apply to stock trading. It's a different kind of technique and execution. But if you can learn how to trade liquid stocks like that, you might be able to develop some strategies where you can take advantage of that. It moves 100,000, move it, you get on board, and then you bang out if it doesn't go. You take a shot at 2 or 3 pennies, but you're going to need a lot of money, and you're going to have to be well capitalized to make that worth your while.
Okay.
Yep.
I understand that with dark pools and larger players, they can delay the publication of their fills by an arbitrary period, such as a day. How can a minnow looking at a DOM or tape know that a move is based on live info or delayed order from Goldman's?
Because what you're saying, this is one of the things too with futures, and I try to tell people this. The futures markets are some of the most transparent. You actually don't have a lot of volume going off in dark pools or behind the scenes relative to total volume, okay? So it's not delayed. What you're seeing, I mean, when I play this S&P breaking right here, it's all there. Those orders are there. They're there right now. If I click at that moment into 1850, I will get an instant fill at 1850. So I think far too many, that's one of the myths actually. Far too many retail traders place way too much emphasis on this idea that they're flying blind. Sure, there are some transactions going off, but it doesn't really matter in terms of what you're seeing right here. That bid is there, that offer is there. These orders are trading right now at the bid and at the offer. And, as a minnow, you're trying to respond to what's taking place in front of you on the exchange. You can't worry about what's taking place in the dark pool or behind the scenes, or if companies are matching order flow. And again, that's an advantage of futures trading, is it is extremely transparent. You don't have as much in the way of brokerages matching orders in-house and getting paid for order flow. I mean, there is some of that, but it's not as frequent. And your real heavy hitters are all members of the exchange. So for them, trading on the exchange like this costs almost nothing. They're not paying what the retail trader is paying in terms of round terms. So don't get too caught up in that. That's my answer.
Okay.
Okay.
Let's see. Who are these investment banks, hedge funds? What do they trade, and what is their time horizon and risk tolerance?
So obviously the most well-known, investment bank is Goldman Sachs, right? I hate to throw them out there because everybody knows them, but it is true that they're massive. They have their hands in everything. Funds might be very well known advertised funds, or they might not be. They might be raising capital kind of behind the scenes to qualified investors. Sorry, what was the second part of that question? What are they? Oh, their time horizon, right?
Their
Their time
time
frame.
horizon and what is their risk tolerance?
Yeah, it completely varies on the firm. So I would like to say that I had a solid answer for every firm. Obviously, I don't because I don't work at those firms. But what you might have is you might have a principal trading firm, a group of guys, 5 guys even, or 8 guys that pull their own money together and they trade it. And their time horizon might be seconds in terms of executing HFT program strategies in the ES, let's say. And on the flip side of that, you may have bond traders or fixed income traders on a desk in an investment bank, and they're actually working 3,000-4,000 contracts on each side, and they're working spread trades, and their time horizon may very well be the entire day. So that's part of trying to identify. I have another thing I did about context and like the products with you guys. I did a video about choosing products. You want to sort of find yourself in products that have some movement and volatility and liquidity. As far as time horizon, you're just trying to respond to what you see in the moment. So sometimes in the moment you see that you can get 2 ticks very easily and that's it. And sometimes you might think you can get 6, 7, 8 ticks. It just depends on the scenario. And their time horizon is the same. It just depends on whether there is a feeding frenzy or not.
Okay. I'm assuming this is going to be geared towards futures. Oh no, he says okay in the bond market. Can market makers or big firms hide their trades from the time and sells in the bond market?
To my knowledge, not in the time and sales, no. They can hide their orders though. So what might happen is you may see, for example, 1,971 contracts on the offer here. But then when it trades, 4,000 actually trade. So you never see that extra 2,000. That 2,000 pops up and it's a hidden order that was sitting there. So they can hide their orders and they can rapidly refresh their orders. But to my knowledge, it all has to show up in the time and sales.
Okay. Can you explain how buying climax / selling climax scenarios work, i.e., where we see huge volume and price changes its direction once it hits those climax points?
Assuming I understand the question correctly, what typically happens is that everybody has adapted to the shift. So for example, this was a day when the S&P fell off a cliff. But what usually happens is everybody just starts going one way, and then eventually it hits an area where all the sharks that ganged up on the short side start deciding to take the money off the table, and then maybe go the other way or maybe stand aside. And then some new sharks come in on the long side, and then there's just this sort of battle that takes place with people adjusting. But what's usually happened there is everybody's already adjusted. The market's already cracked 10, 12, 15, 20 ticks, and anybody who was on the long side already got out for a loss and possibly reversed. And then the people that are on the short side try to ride it as long as possible. And then people start covering and working smaller orders and working, for ticks now instead of maybe 7, 8 ticks. And then it just kind of finds an equilibrium. And once it finds that equilibrium, it goes back to the situation where everybody is waiting for the other guy to make the move, and unless a group of sharks steps up again to make a move, nothing's going to happen. And that's pretty much what happens at those peaks. You know, it's where it sort of finds equilibrium finally, and everybody adjusts their positions, and then the sharks are done, and then it just stops moving.
Okay. There are a couple of questions asking if you can share on the website the text document that you're reading from.
Yeah. Is there a way to?
You can email it to me and I can post it to the thread for the webinar.
Yeah, that'd be great. Let me just do that because I don't think I can share it. Yeah, I'll email it to you after the after we shut down. Okay.
Okay. When huge option orders hit the tape, stock price jumps right after filling that option order. Any idea why?
Most likely, I mean, that's just a response to seeing the options order. And that's what I mean about, you know, the key word there being huge. Again, right, size we're talking about. So even though I'm not a huge, you know, I'm not a stock trader, it's the same concept. So you have a bunch of smaller traders out there in the world monitoring the time and sales. And then when they see a big order come in, again, from a shark somewhere, or maybe a small group of sharks, they respond to that. And then that initial response creates that domino effect, which pops the market, you know, a couple of ticks, or pops the stock maybe a few cents. It's just all based on a response to big orders being moved around by big players.
Okay. Do you know if institutional algorithms can read if there are any retail orders in the queue at any given price? Sometimes I get stopped out and price turns in my way.
So, so I get that a lot about programs picking off orders, and let me just respond in this fashion. Usually, if you've done that, you've made an error in judgment in the trade. You know, you're probably involved in a spot where you may not need to be involved, or you weren't really maybe too committed to the trade in the first place. I don't know. There's different reasons for it. The answer is, I don't know. There should be absolutely no way they know whether or not a one lot is from a retail trader or a one lot is a part of an order of 200 that's broken down by a trading firm. That should all be anonymous information transmitted to the exchange by the broker. And again, you know, they're not picking off one lots or five lots from retail traders. You know, I mean, they are if it's there and they get the fill, but ultimately they're playing kind of against other traders that are moving 20s, 50s, 100s. So I know it seems like that happens frequently. You know, it's like, oh, I blew out, and that's exactly where it turned around. But if you really study those trades, FYI, I highly recommend recording your own sessions and studying them yourself. You usually find out that you were probably not in a very good spot to begin with, and maybe didn't have the best strategy in terms of trade management, in terms of a stop loss and a projected profit target.
Okay, let's see. Do you only trade with the order book, no tape or charts?
That is correct. I will look at a chart in the morning just to kind of make, not obviously for patterns, but to remind myself of maybe, like, for example, if you see these little R's here, those are just your basic resistance points where the market had stopped, you know, either a day prior or 3 days prior or something like that. And yeah, so I make a note of those points just to kind of know where the basics are. But then I minimize the chart, and all I watch are the order books for the rest of the day. Anything you can see this is the way that I say it. There are things I can see in the order book that I cannot see on a chart, but anything that I see on a chart, I can see in the order book, and I can see more in the order book. So that's why I focus on the depth of market.
Okay. Uh, do you reference longer time frame zones of support and resistance when you day trade?
Just in terms of like what I was explaining there, I mean, I will certainly, if actually, for example, that was like this 1950, that was a very obvious support level in the ES. So I certainly will reference that and possibly trade around it or see how the market responds around it. Anything that I know, or any place where I know, everybody's watching it, then I'm going to watch it as well. But outside of that, not really. Like I don't really pay attention to whether it spent 5 hours 2 days ago in a certain range. I try to stay a bit more focused on the here and now.
Okay. Um, what is your opinion on the correct amount of capital needed to successfully trade the way that you teach?
So I don't really like to answer that question. Here's why. Um, it all depends on the person's situation, right? And it depends on the person's skill set and everything else. There might be guys that are talented that can end up running 10,000, into 50,000, and there might be other guys that are more the types that, it takes them 20,000 to make 10,000. So it really does depend 100% on the individual. Obviously, more is better, and you want to leave yourself a lot of room for potential drawdowns. So, to make a living at it, you obviously have to be able to trade a decent amount. You're not going to make a living on a 2-lot. But at the same time, you shouldn't be trading a 10-lot if you can't make money on a 2-lot, right? So it just depends upon the person and their financial aspirations, goals, and their skill level.
Okay. How can you recognize that the shark is in, and how can you utilize it to your advantage?
So recognizing when the sharks are playing is about identifying size moving, right? So when you have a market being hammered like the ES was on this day, there's absolutely no doubt that in that kind of volatility, the bigger players have their hands in the game, right? So you're looking, that goes back to what I had said about trying to identify the feeding frenzy style type thing. You're looking for spots where it appears a group is pressing hard and other traders are responding to it, right? It's the domino effect. Sharks aren't really playing when the market's barely moving, and the market can go from 0 to hero in a matter of 2 or 3 minutes sometimes. So that's kind of how you want to assess when you want to be involved and not. You're looking for size, really hitting, pressing. They're wiping out orders of 5, 6, 800, no problem. Versus you're sitting there and you're watching, like in the additional or other example, you watch a 1-lot trade and then a 1-lot, and then a 5-lot, and then a 5-lot, and then a 2-lot, and a 2-lot, and a 5-lot, and a 5-lot. And over the course of 2 minutes, the market doesn't go up or down tick, right? So in that situation, you can be sure that the sharks are not gearing up to. I'm not sure, but usually that's the difference. They're not really gearing up to make a move. You're just going to see some back and forth on light volume.
Okay. Uh, When you predict a breakout, which do you recommend to use? A market order or a stop volume order?
Um, Typically these days, unfortunately, all of the HFT programs beat you to the punch in the stop volume order. So it's been my experience that if you're trying to anticipate a move, particularly like that, like a breakout like that, you just got to step up and use a market order and just click it, or whatever the case may be. Like we were seeing over here, it's if you want to be short and try to catch a break to the bottom, you got to step up and sell the next price. I mean, that's all there is to it. If you're trying to wait, on a volume stop, or you're trying to wait on your limit order, the market often runs away from you. So I do use limit orders frequently in the treasuries. Treasuries are a bit different in terms of the way they move, but even in the treasuries, I use market orders quite a bit when I think the market's going one direction, because I know I'm never going to get the limit fill if I'm right about the move.
Okay, perfect. Let's see. What are the advantages of reading the tape on the book instead of working on a ladder-like chart, i.e., the Gomi footprint?
Um, well, okay, so this is just my take on it. I know that some people do like footprint charts, and I'm not trying to sway them from using them if they use them effectively by any means. But the reason that I place so much emphasis on the order book itself and just the ladder is because that's where the key information is right now. So I feel as though you make the best decisions if you're 100% in the moment right now. And even with the footprints, at least you are seeing volume, right? You're not just seeing lines, you're seeing volume, and that's a step in the right direction. But sometimes guys can get a little bit too lost looking at a footprint that was created, 6 bars ago, depending on whatever the time frame is set, right? And so they're looking at what happened 6 bars ago in the footprint rather than looking at what's happening right now in the order book. And then they end up missing out on a trade or getting maybe kind of a bad read because they're not paying attention to the current moment. So, I mean, I realize that what I do or like what I show is pretty hardcore to most people in terms of just focusing 100% on the order book, but I do it because it keeps me in the moment, and I'm able to watch the bids and the asks, which can also give a lot of information at times, as I was showing in that one trade where I was holding onto the trade because I saw the orders cancel underneath. So that's the kind of stuff you might miss if you're looking at footprints. But that's just, my personal preference.
Okay, let's see. Let's see. Can you explain a bit about what an iceberg order is?
Yeah, an iceberg is a hidden order, basically. I'll show you one if I can find it. Here you go. All right, visuals speak louder than words. There's 1,544 on the bid, but when that trades, you're going to see 5,000 trade. There's 2,000. There's 4. There's a little bit of a freeze there. There's 4,000. Let me back that up and see if you can see it actually happen again. See that? That's an iceberg. That's a hidden order or a refreshing order that's, you cannot see until you're the guy that sells into it and gets throttled because some chart eats your lunch with that iceberg order and then jacks the market back up in your face. That's what that is. So hopefully that makes sense. It's just an order that refreshes or is hidden, and you see like that 1,500 on the bid, but there's actually, I think there were like almost 6,000 trade there. Yeah. I tried to go long actually, and I thought about it for 10 seconds too long. Anyway, that's what it is. So 5,700 ended up trading there, and it never shows.
Okay. Let's see. How many markets do you trade at the same time?
Typically only one, unless I have like a really strong opinion on both treasuries and the ES, although it can be hard to focus on both. I watch all four treasuries because the treasuries are a little bit of a unique market in the sense that you have these four, and then you also have the 2-year notes and some other products, but there's an interplay due to spreading. And so if you're going to trade treasuries, you should really watch all four of these. But I primarily trade the 10-year, sometimes the 30-year, sometimes the 5-year, but mostly the 10-year. But I'm watching all of them.
Okay. Let's see. Is there a metric or set of metrics to watch to determine whether I am making it as a trader?
What I tell people is there is, but what you typically have to do is you have to sit there for a few months, and nobody ever wants to hear that, but it's true. You don't become good at any job, in a month. You have to sit for a few months and just trade, and make a couple hundred trades really, and not necessarily live. I mean, you can sim trade, whatever, right? I'm not advocating that if you're just blowing through money, but even on a simulator, just make a lot of trades and start to try to get a feel for like a bigger picture in your product and become a specialist in one product. The metric would then be obviously numbers of winners to losers, but really more importantly too, your risk to reward. So, what are you making when you're wrong versus what you're making when you're right? And so if you're hitting the point where you're consistently hitting better than 50% and you're also keeping your losses maybe to 3 ticks, but getting 3, 4, 5 tick winners, so you're extended there. Your largest winning days, normal stuff people talk about. Largest winning days is larger than your worst losing days, etc. That's when you know that you might be on the right path. Obviously, if you're getting hammered and you're losing on 70% of your trades and that kind of stuff, then you should probably not be trading live. And you want to reassess. And a very useful tool is to record your trades and go back through them every day and really try to be honest with yourself. And say, based on what I know about this market, was this actually a decent entry? And if it was a decent entry, did I manage it properly, or did I make mistakes? Did I chase a loser? Did I try to use a limit order to get out, and then I lost 4 ticks instead of 2 ticks, that kind of stuff. And you'll be surprised at what you can learn about your own trading if you'll do some honest self-review every afternoon after you stop, or even the next day, take a break and come back the next day to the video.
Okay, let's see. Okay, I'm gonna make this the last question because we're running long on time.
Sure.
What would be the one technique or strategy for a new Dom trader to focus on to become proficient?
Definitely, I'll tell you exactly what it is. Don't focus on one setup. What you want to do is you want to view the markets as organic. Like in terms, and what I mean by that is they're reactionary creatures. So I do constantly get asked about, well, what's the one setup? You know, what breakouts or range plays, or should I be looking for icebergs, or should I be looking for this or that, right? And the truth is that you want to view the entire thing as one big organic or one big organism, and try to just get a feel on a daily basis for how the markets tend to ebb and flow. And that prevents you from falling into the trap of only going for breakouts or only going for range plays. It allows you to start getting a feel for, just, I guess, how it all works. That's how you start to learn how the Sharks play the game. That's the other thing we can finish up on. It's the equivalent to, if you sit in a poker game with the same 9 guys for a year, you should learn how those guys play, right? At the end of the year, you should have a pretty good idea of how they tend to play. Now, they may vary up their game one night. One game, a guy might get drunk and start firing off chips or whatever, which he doesn't normally do. But in general, you can learn how they tend to play, and that's what I say about the markets, is you want to try to view the whole thing as a poker game and learn how the other players tend to play, and then that'll help you assess in the moment whether or not there might be a good opportunity or whether it's just unreadable. And quite frankly, sometimes it really is. It's just completely unreadable. You're completely at the mercy of the next guy who trades 2,000 contracts, and there's just no feeding frenzy. There's no information available. So you want to not be involved during those times and try to identify the times when you do want to be involved.
Okay. Thank you for the webinar, the information, and most importantly, your time today.
Thank you, Tara. I appreciate it greatly. Thanks to everyone for attending. And as soon as I get off here, I'll email you that document that you can forward or post or whatever, okay?
Sounds great. Thank you.
Mm-hmm.